All right, newly installed Fed Governor Stephen Miran is saying he favored a bigger rate cut at the recent FOMC meeting. Here with the latest on this story is our Fed correspondent, Jennifer Schonberger. Jen.
Good afternoon, Miles. New Federal Reserve Governor Stephen Miran said he favored a jumbo-sized rate cut at the central bank's policy meeting earlier this week because he doesn't see any inflation from tariffs, and he favors a policy rate that does not restrict the economy nor spur it. Miran telling CNBC in an interview earlier today, quote, "I don't see any material inflation from tariffs." He pointed to the prices of imported goods on a core basis, which exclude those volatile food and energy prices, and said why prices haven't actually been higher. While he didn't express outright concern about recent weakness in the job market, he noted that job growth was weaker than thought over the past year and that keeping interest rates at a level that restricts the economy poses risks to the health of the labor market. Miran confirmed he was indeed the one who penciled in 5 additional rate cuts, in addition to the one that we saw earlier this week, for a total of 6 cuts this year. Miran was the lone dissent in his first meeting as a Federal Reserve governor, preferring to cut rates by 0.5 percentage point instead of the 0.25 percentage point cut that the rest of his colleagues voted for. He's expected to give a major speech on Monday at the Economic Club of New York, in which he will lay out his views for the economy and monetary policy in depth. Miran, who joined the Federal Reserve Board just on Monday, has prompted concerns about central bank independence because he is on leave of absence from his role as White House economic advisor, not resigning while he serves at the Fed. Miran told CNBC that President Trump called to congratulate him on Tuesday morning, the very morning that the Fed kicked off its policy meeting, but that he did not talk to the president about how he would vote on policy and has not spoken with him since. Miran said, quote, "I will do independent analysis based on my interpretation of the data, based on my interpretation of the economy." Now, elsewhere, Minneapolis Fed President Neel Kashkari expressed in a new essay today that he is more concerned about weakness in the job market than stickiness of inflation, and that has prompted him to pencil in 3 rate cuts in total for this year, up from 2. Though he added the caveat that if we do see any resilience in the job market, any strengthening there, that the Fed could hit the pause button on further rate cuts and even hike if necessary. And meanwhile, we also heard from San Francisco Fed President Mary Daly just last hour, who said the Fed cut rates to support the labor market. Miles?
Now, Jen, you mentioned that Stephen Miran will speak next week. And we were talking earlier today, it seems like just about everybody else on the FOMC will speak next week as well.
Yeah, it's going to be a very heavy week of Fed speak next week. Monday, it kicks off in the morning with New York Fed President John Williams, who's going to be speaking on a panel on monetary policy overseas. That same day, we're going to be hearing from the head of the Cleveland Federal Reserve, Beth Hammack, as well as St. Louis Fed President Alberto Musalem, Richmond Fed President Tom Bark, and of course, Stephen Miran, as I've mentioned. Tuesday, we'll hear from Fed Chair Jay Powell himself, along with Fed Governor Michelle Bowman, on their economic outlooks. Wednesday brings San Francisco Fed President Mary Daly. Thursday, we've got Chicago's Austin Goolsbee, Dallas's Lori Logan, and Fed Governor Michael Barr. Rounding off the week, we'll hear again from Richmond's Tom Barkin and Mickey Bowman, who's going to be more focused on regulation. So not a moment of downtime on this beat. That is the Federal Reserve. Miles, back to you.
Well, Jen, they do a blackout period 8 times a year. They take the week off before the Fed meeting. All right, so that's when we get the downtime. This, of course, the busy season. All right, Jen, have a great weekend.
Thanks, you too.
All right, well, after the Fed delivered its first rate cut in about a year, Morgan Stanley is now looking at the path ahead for the Fed. And we are joined now by Morgan Stanley's chief U.S. economist, Michael Gapin, to talk about where the firm sees the Fed headed into 2026. So, Michael, let's just start with your view on what we heard from Powell on Wednesday and this pretty clear split among the FOMC that I think comes through in the dot plot. It's a unique period, I guess, for Fed policy in that context. And, kind of as you look at what you think the Fed will need to do, where do you see things headed into 26, where there's even less agreement on the path ahead from the committee?
I actually think Chair Powell's message was fairly straightforward and simple. He just said we see increased downside risk to the labor market. The hiring rate has really come down. Yes, we know immigration is playing a role in reducing growth in the labor force, but obviously the more employment growth comes down, the more concerned we are about the outlook for employment and spending. So we need to react to that. And inflation has moved higher, but maybe not as high as we thought. So I think to reflect that shifting balance of risks, Powell and the Fed are saying we need to move towards neutral. So it is, in my mind, more of a recalibration in the stance, meaning I think they expect to do several more moves. We do think that they'll cut two more times into the end of the year. Restrictive isn't appropriate in their mind. Something closer to neutral is. And I think the data is giving them a window to get there at a fairly regular clip, meaning 25 basis points at consecutive meetings through year end.
Now, at Jackson Hole, Powell it's not a pivot. It's not a pivot. But he set up this idea that the labor market was now where the Fed was going to be spending most of its attention. And you talked a little bit in your most recent note about, what it would take to really start to see a change in a labor market that appears to pretty clearly be saying things are slowing down. What are you looking for, and how much do you think the Fed can influence that as we head into, again, an environment where, I don't know if we're going to see a 5 handle on unemployment, but it feels like higher is where U3 is headed.
Yeah, I think so. There are a number of forces probably restraining labor demand, right? So this isn't just about where monetary policy is. Monetary policy has been modestly restrictive, so it would be weighing on interest rate sensitive sectors like housing, construction, maybe finance. But trade policy uncertainty has been a factor. Immigration controls have been a factor. So there's a lot of policy uncertainty weighing on the economy in addition to monetary policy. So the Fed can do its part, but I think what you're getting at is there may be a prolonged period of soft demand for labor, which could start to push the unemployment rate higher. So, and we do think that will be the case. Immigration will likely prevent the unemployment rate from moving sharply higher, but the economy does seem to be creating slack in the labor market, albeit slowly. Again, we don't think the Fed needs to move rapidly here, but they probably do need to recalibrate their stance. But the last thing I would say here is remember, the Fed isn't saying we want monetary policy to be easy. They're just saying, let's make it less restrictive. We still have to keep an eye on inflation. We just need to be better balanced between what's happening, right? So they feel like, as Powell said, there's no kind of risk-free move. There's no obvious choice here. Inflation's moving higher. The unemployment rate is moving higher. So in some ways, you have to pick your poison. Right now, they're saying we're okay with supporting the labor market. It's probably going to come at the expense of higher for longer inflation, but that's a trade-off they're willing to take.
And then, Michael, we'll just finish with kind of what you see as the biggest downside risks to the economic outlook right now, whether that's something that Powell pointed to or something else that you and your team have been exploring.
Well, I think that there's a story here of, let's call it, the next few quarters and then after that. I do think maybe through the first quarter of the year, the biggest risk to the economy and the labor market is that we're only about 3 months in to the time under which corporates are passing through tariffs to the consumer. We think that they'll be able to pass enough through such that they don't need to cut labor, but I think the risk is maybe they can't pass through all these costs to the consumer. If that's the case, I mean, the tariff bill is a big bill. If you annualize the past 60 days worth of tariff collections, it's about $355 billion. So somebody has to pay that. And the risk is corporates cannot pass it on. Therefore, they need to preserve margins and earnings by reducing labor. And I think between now and maybe the first quarter, that's the primary risk. The further you look out, though, if we get past that period, then the fiscal bill starts to kick in, monetary policy easing may start to have some effect, and then I think the balance of risks can shift perhaps towards the upside in 2026.
All right, we'll leave it there. Michael Gapin, Chief U.S. Economist at Morgan Stanley. Always appreciate the time.
Thank you.
All right, now it's time for some of today's trending tickers. Yahoo Finance's Brooke DePalma joins me here at the desk instead of across the desk from me out in the newsroom. Let's start with CoreWeave. That stock is rising today. Loop Capital out initiating coverage on the stock with a buy rating.
Yeah, well, happy to be here at the physical desk inside the studio. Loop Capital analysts saying today that there remains a material underappreciation for how committed the hyperscalers and major AI labs and frontier model builders remain to pushing the innovation envelope forward. So, of course, hyperscalers are the group of AI providers like Amazon, Microsoft, Google. Worth noting here that CoreWeave's biggest customer is Microsoft. In the latest quarter, it made up about 70% of CoreWeave's revenue, and the analyst sees CoreWeave shares rising to about $165. Right now, we're at about $125. But it's important to note here that this company was one of the early IPOs this year. If you see the run up that we've seen over year to date, more than 200% after really got that momentum this summer as this AI tech rally really led off. But there are some concerns on the street. Analysts are concerned about what exactly happens once these companies like Microsoft and Meta and so on really build their own data centers here, and also that mounting debt that they have, of course, with these higher interest rate environments.
Yeah, it was, I don't want to call it a controversial IPO, but there were a lot of people with a lot of questions about it. Stock's about 20% off of its high that it hit back in June. But yeah, I mean, when I think you take a step back and you look at the 2025 class of IPOs, CoreWeave is certainly going to be a standout among there.
Definitely
All right,
outperformed.
let's turn our attention now to nuclear stocks. This has been another interesting area of the market. Those stocks and really the whole sector getting a lift as the US and the UK yesterday announcing plans to further increase cooperation and investments in the nuclear space, Brooke.
Yeah, really extending those rallies that we saw on Thursday based upon the announcement that President Trump teamed up with UK Prime Minister to announce what they're calling the technology prosperity deal. And really it's an agreement between the two nations to share research and findings around artificial intelligence, nuclear energy, and quantum computing across healthcare to lower energy costs and really support national security. The release also says on the White House's website. In addition to that, these two companies, if you take a look at the extension that they've had of these rallies today, up more than 20% for NuScale Power Corporation, Oklo up more than 25%. And I think this really just speaks to the potential need of the space and need to have around the AI arms race. We ultimately need in the back end to have the nuclear energy to support this. And we're hearing calls in the street, like from Bank of America, calling nuclear energy a $10 trillion potential market. And they said that there's a need for global nuclear capacity that'll have to triple by 2050. And so really the overall, just this need to have for nuclear energy in order to meet this AI arms race need.
You know, another AI derivative trade. Anytime you can get one, Wall Street is going to go find one at this point.
Pop out of it.
All right, lastly, let's talk a little bit about Fiverr. That stock getting a lift with BTIG upgrading the stock to buy from neutral.
Yeah, this is a pretty interesting company. So it's a marketplace for freelancers. So I feel like this was really big when we were talking about the gig economy about 5-6 years ago now. And this company now sitting a bit under pressure year to date, down more than 14%, now sitting at $27 after this pop that we did get today. But largely this is because of the upgrade that they got from BTIG, upgrading, like you said, online marketplace from buy to buy from neutral. Right? I had my notes on the side. But really, in addition to that, they have this restructuring at the company. They're set to cut the headcount by 30%. Analysts speculating that could be about $30 million in cost savings. And the CEO was quoted saying that the transformation requires a painful reset, and that's really what we're seeing here now. Also, perhaps a boost because of the interest rate cut.
Well, there are two things on this. One, because we were just talking about CoreWeave with this year's IPO class.
Yep.
Fiverr was one of the big IPO stars back in 2021.
Yes, okay, so 4 years ago.
But it was very hot in that 18-19 period running into it. And it was like, oh, okay, 2021, any company can go public, and they were among the companies that did. But we were also discussing earlier, weakening labor market, good for freelancer marketplaces. So it's almost like it's an inverse play on the overall economy. In addition to management is just out here saying, hey, we're going to cut our costs way down, which is something that investors are generally usually supportive. And the stock's down 80% from its all-time high.
And then if you take a look on the flip side, also in the call, the amount of times AI was named just because of people really not needing maybe those freelancers who did those small day-to-day tasks. Now AI is being used for that. So they sort of cut that out of their business. But they did say that people need to know how to use AI, and so they're looking for more perhaps technologically advanced freelancers to take on some of those roles. So really a bit of a twofold here.
All right, Brooke, great stuff. Have a great weekend. Coming up, we're looking at 2 stock picks with an expert that may leave you saying, hey, that's a good buy, or it's time to say goodbye. We're coming up with that right after this. Goodbye or goodbye. Our goal, to help cut through that noise to navigate the best moves for your portfolio. I'm here with Todd Sankwitz, the Free Markets ETF portfolio manager, to talk about a couple of plays today. So Todd, let's start with Doximity. It's a name that you are bullish on. We're going to start here just taking a look at the chart and thinking through what's just the overall setup that you see, with this name.
It's very interesting with this name because this was an actual real decision we had to make not too long ago when the One Big Beautiful Bill was passed, and that made permanent the telehealth safe harbor. So essentially, Doximity really has a strong competitive moat.
Yep.
What we're looking at with Doximity is that they have 80% of the physicians on their platform, and they are very unique, and you don't have a really lot of the competition right now with them.
And I'm just curious, in a vacuum, how deep is that competition for, provide the companies that are helping me find my way to my doctor via the phone? Because obviously not something I was probably thinking about doing 10 years ago, but now is more or less the default way I could ever get in touch with the physician.
Yeah, so it's very interesting because the way to think about Doximity is it's kind of like LinkedIn for doctors.
Yeah.
So it's a technology platform that's allowing doctors to connect, communicate, and share information.
All right.
So really that's what that's about. When we look at the stock.
I jumped ahead. We'll leave that there.
We'll be having a different conversation.
That's right. We'll leave that there. All right. Sticking with Doximity then, let's talk about the financials and what you kind of see when you go through the income statement and the balance sheet there.
Yeah, exactly. So here we're looking for a company first and foremost that really doesn't have a lot of debt. It's pretty much de minimis for this kind of company. And what we're seeing over time is we're seeing very strong revenue growth, expanding margins, and we're seeing a company that's really about responsible financial growth, right? But at the same time, they're kind of exploding within their space. So that's I think a very strong point for Doximity right here.
All right, and then talking about the mix of revenue, and I think when it comes to healthcare, there's, the theory always sounds great. There's so many ways to, kind of make the healthcare system cleaner, but huge regulatory burden. So how, when you look at Doximity and where it fits in there, what that setup is for the company?
This is what I love about Doximity because they really don't have a whole lot of regulatory burden, which seems kind of counterintuitive when you think about investing in a fund that's going to benefit from deregulation. Because really what happens at the end of the day, Doximity is sitting at the intermediary, right? More of a technology company in the healthcare space. So what they're doing is they're providing that facilitation. So they're giving doctors a way to communicate with patients, a way to communicate with each other. They're integrating with electronic health record companies and things of that nature. And they generate a lot of revenue, just like we see with a lot of social media organizations through advertising, particularly with drug advertising to doctors.
Yeah.
So that may shift a little bit, but at the end of the day, they're not subject to regulation themselves, but they can benefit from telehealth rule relaxation so that they're better delivered, so doctors can better deliver that to patients.
So even though they're kind of dealing with, doctors' communication, et cetera, they're not sitting there saying, we ourselves have a major, HIPAA issue around those kinds of communications. That sort of stuff tends to sit, with the care providers?
Exactly. Yep. They're the facilitator.
Great. All right. Let's move on to another name. Let's see. To a name. Oh, we have a risk. Yeah. We have a risk. We have a risk. First time. We have a risk. All right. Let's talk about all the things we liked, something we maybe don't like about Doximity.
Yeah, I think really when you look at Doximity, it's been priced to perfection. It's trading at a very high forward PE ratio, about 61. And so if you see healthcare organizations reallocate those budgets to electronic health record organizations, and they have direct communication platforms, so if they shift a little bit, that could obviously cause the stock price to decline because we're going to see that valuation adjust really quickly.
All right, let's move on to a name that we like a little bit less, maybe a good buy in the portfolio, and that is Teladoc. I kind of teed up their business model, getting the two confused here. We see the chart, doesn't look like the most constructive thing I've ever seen. When you think about a company like Teladoc, where do you start with not liking this stock?
Yeah, so Teladoc is actually the healthcare provider, right? So telehealth provider. So really at the end of the day, what we're seeing is we're seeing a lot of competitive pressures within this space, and so we see more people moving into this. So in fact, deregulation, where it could benefit it could also affect companies like this who are directly tied and delivering that healthcare because more entrants can move into this space easier.
And then when we look at the problems that they have on their financials, when you look at their income statement, their balance sheet, what stands out to you that you don't like around Teladoc's story?
They're way down by debt. They have a tremendous amount of debt. They have very high interest expenses, and they really just aren't growing. And those competitive pressures are a primary reason. As more people move into into this space, there's more players to basically contract with from a telehealth perspective, and these guys are suffering from it.
So it's a little more like, it sounds like a tech play, but it's actually a medical play, and then the financials of medical play are not going to quite be what people think they're signing up for.
Yeah, and what you're going to see really with the third point here is exactly that, because when we look at the third point, right, their deregulation can give them a lot of leverage, but at the same time, we have a lot of reimbursement risk. And this is not something that's unique to telehealth. Right. This is something that's happened across medical care in general, right? As health insurers are being more critical of basically what they're reimbursing for and what services and what's being charged, this is an ongoing risk. So it's not unique to telehealth, this is unique to healthcare in general.
Yeah, I mean, I know, the story obviously has a lot of other complications to go with it, but United Health is coming out every quarter just saying, well, more people are using our services, and that's a major problem for them. And so, yeah, you're right. The more you move into that space, the more you bring those on board yourself. Now, possible upside here for Teladoc, maybe something that could turn the story around in ways that are different from how you're seeing it today.
Yeah, so they're leveraged to regulation, so obviously more favorable regulatory environment is going to be great, which I think is what we're in. So I think that's a tailwind, but unfortunately I think their debt is a huge burden to them, like we spoke about. Now, if they could successfully restructure that debt and they could reduce that interest cost, I think that this could allow that company to reinvest that money and potentially grow and turn this story around from a bear story to a bull story.
All right, well, they'll stay locked in on what Jay Powell does over at the Fed on that basis. All right, Todd, appreciate the time.
Thank you.
And that's it for Goodbye or Goodbye. All right, coming up, Wall Street is having a honeymoon phase in a post-Fed rate cut world. We're digging into soaring stocks when we return. All right, well, stocks are at record highs after the Fed's first rate cut of the year, with Fed Chair Jay Powell calling it a risk management cut to cushion a cooling labor market. But with valuations now nearing levels we haven't seen since the late 90s, the question is whether this run is justified or if we're drifting into worrisome bubble territory. Senior markets reporter Alec Canal breaks down what strategists are saying.
Historically, Fed easing at market peaks have often led to more gains, but now valuations are pushing towards those higher levels, and Wall Street is divided over whether this rally is very sustainable moving forward. Some strategists argue AI-driven earnings growth justifies today's multiples. Others warn that Fed cuts could spark a dangerous melt-up, while some skeptics see bubble risks building as inflation lingers. Here's what they told us this week.
I think it can be justified. And if you look at the earnings prospects for these companies, you're talking, earnings expectations that have come up.
It's just amazing to see. The market pretty much has selective hearing right now, and all it's hearing is Fed cuts, which are great news for risk assets. It almost feels like bad news is good news and good news is good news, because all of it means that the Fed here is going to continue cutting. The S&P 500 right now is trading at 22.5 times forward earnings. The most expensive they've ever been in the late 90s was 24 times. So we're certainly getting up there.
We're in the camp that thinks that inflation will be stubborn, and therefore we expect at some point in time this incredible mania, this bubble that has now been exacerbated by the race for AI. When it breaks, there's going to be a lot of heartbreak because the S&P 500 is completely twisted up in the game.
Now, Wall Street strategists have been hiking their price targets across the board, citing Fed easing along with AI. They did warn that some volatility is warranted in the interim, so we'll see where stocks can end up. But in the meantime, those bubble risks, they are starting to become more of the conversation.
All right, well, that wraps up today's market domination, but don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.